If you stay, I'll teach you the best swing trading strategies that work on any market, whether it's Forex, stocks, or crypto. The first strategy involves the monthly pivots, which are the secret weapon of swing trading. They are based on the previous month's high, low, and close, and will give you a rough idea of where the market might find support or resistance in the coming weeks. Monthly pivots are like the big boss of support and resistance levels. They carry a lot more weight than your average daily level. That's because they represent a whole month's worth of price action, not just a snapshot in time. These levels act as a magnet, attracting the price on higher timeframes. The big market players are watching them, and when the price interacts with a monthly pivot, it can trigger some serious fireworks. The more time the price spends above the pivot, the more reliable it becomes as a support level. And the more time the price spends below the pivot, the more reliable it becomes as a resistance level. The strategy here is to look for confluences between the monthly pivot and supply-demand areas. It doesn't happen every day, but when it does, it can be a sign of something special. Let's say you're looking at a chart and you notice that the price is approaching a key demand area that lines up with a monthly pivot. That's a confluence, perfect for a swing trade. If the price bounces off that area, it could be the start of a beautiful uptrend that you can ride for weeks or even months. On the flip side, if you see the price approaching a major supply area that coincides with a monthly pivot, it could be a sign that the buyers are about to run out of steam. If the price gets rejected at that level, it might be time to start hunting for short opportunities. Of course, these confluences between monthly pivots and supply-demand areas aren't the only thing you should be looking for. You'll also want to keep an eye on candlestick patterns, like pin bars and engulfing bars. When you find a candlestick with a long wick rejecting the monthly pivot, that's a really good signal. Now, what if the price blows right through the monthly pivot? It will happen because no level is unbreakable, and sometimes the market will just keep moving with momentum, even on higher timeframes. Even if the price does break through the monthly pivot, it can still give you valuable information about the strength and direction of the trend. For example, if the price breaks above the monthly pivot, it could be a sign that the buyers are in control and that the trend has momentum to continue. The pivot that once acted as resistance now becomes a new support, helping the price to reach new heights. On the other hand, if the price breaks below the monthly pivot and starts to accelerate, it might be time to start looking for short opportunities. The sellers have taken control of the market, and they'll do everything in their power to keep the price from rising back above the pivot. Now the pivot has become a resistance, pushing the price down when it tries to break through. The second swing trading strategy involves using Bollinger Bands indicator. It might look a bit strange at first because you're going to use 3 Bollinger Bands. First, add Bollinger Band with a period of 50 and a standard deviation of 1. Then add the second Bollinger Band with a period of 50 and a standard deviation of 2. The third Bollinger Band will have a period of 50 and a standard deviation of 3. With this setup, the trend is pretty clear to see. Let's consider an uptrend with different stages. When price is between the middle line, the 50 EMA, and the first band, that's a weak uptrend. In this area, there's no strong momentum. Price is likely to bounce around in a range and might even dip below the middle line. You can buy in this area, but only if you have other factors lining up. When price is between the first and second Bollinger Bands, above the 50 EMA, that's a strong uptrend. There's a better chance that price will keep going up. As long as candles keep closing in this buy zone, the odds are in favor of holding current long positions or even opening new ones. When price is between the second and third Bollinger Bands, above the middle line, that's a very strong uptrend. Price is stretched, and I would avoid buying if price goes outside the bands. Looking for overlaps of major support and resistance levels with Bollinger Bands is a great way to find swing trading setups. These confluence areas tend to attract more buyers or sellers, leading to a reversal or a trend continuation. With this confluence, you're basically finding pullbacks in a strong trend. When a market is in an uptrend, meaning price is above the middle Bollinger Band, and you find a confluence between a recent support or resistance level and one of the standard deviation bands, you can trade a bounce off that area. On the flip side, when price is in a downtrend below the middle band and a recent support or resistance lines up with one of the lower bands, a decent pullback trade might be setting up. Looking at this chart, it's obvious how much price respects the bands. Even when price was below the middle band, it found support at the lower bands. And here, price broke above the middle band and also broke this resistance level, which could potentially now act as support. Here's our value area. The first band above the middle line and this level are lining up at the same point. This is a solid trend continuation opportunity. Finding profit targets is very easy. You just aim for the next bands. The first take profit is at the second band, and the next target is the last band. As a tip, always expect momentum to slow down when price reaches the next set of bands. That's why it's best to take some of your profits at these levels. The third swing trading strategy involves taking advantage of round numbers, and we'll confirm the signals using two exponential moving averages. First, you plot a 50-period EMA applied to the high price, and another 50-period EMA, this time applied to the low price. These lines will act like dynamic support and resistance levels. The beauty of this channel lies in its simplicity. When the price is trading above the channel, it's a bullish signal, suggesting that the trend is up, and it's time to look for buying opportunities. When the price is below the channel, it's a bearish signal, indicating that the trend is down, and it's time to consider selling. When you combine this channel with the psychological significance of round numbers, you've got a really good swing trading strategy. Round numbers are those big, juicy price levels that end in double or triple zeros. These levels hold a special place in the minds of traders, often acting as key areas of interest. Round numbers are not just some arbitrary figures on a chart. They are psychological anchors and catalysts for market movements. There's a deep psychological aspect that makes them so powerful. We are naturally drawn to whole numbers, and we tend to assign more significance to them. When the price approaches a round number, it's like a magnet, drawing in all sorts of attention and potential trading activity. Here's how you find signals. First, you look at the moving average channel to determine whether the market is in an uptrend or a downtrend. Then you locate the closest round numbers that the price is approaching. This will be your key levels to watch. If the price is in an uptrend, supported by the moving averages, and approaching a round number from below, you look to buy a breakout above the level. If the price is in a downtrend and approaching a round number from above, you look to sell a breakout below the psychological level. This channel acts as a trampoline. When the price breaks it and then returns to hit the upper or lower EMA, it's like a test bounce. If the channel holds and the price bounces off it, it's a confirmation that the channel is indeed valid. This first bounce is crucial because it validates the channel as a significant level of support or resistance. When you have an initial bounce, be ready to trade the next bounces near round numbers. So very important, an initial rejection of the channel is a good sign that the channel is holding firm and that the price is likely to respect it in the future. This second or third bounce is like a green light, signaling that it's time to pay attention and prepare for a potential trade. Another crucial tip: when the price is caught inside the channel for more than 4 candles and is located near a round number, avoid taking a trade. In this situation, the market is experiencing consolidation. It's a time of uncertainty where the price is searching for direction inside the 2 EMAs. Trying to trade during this period is like trying to predict the outcome of a coin toss. It's like a gamble. And that's why, when the price is trapped inside the channel for more than 4 candles, even 3 candles, Simply stay on the sidelines and wait for clarity. You want to see an immediate reaction around the channel, a quick rejection of the area, like in this example. Now, if you want to learn other trading techniques, you definitely must watch our next videos.